course, George Tsilis joins us for a look at some of the analyst commentary, a little earnings update, too, from Macy's, and an interesting story on GM. George, let's start with the note on the home builders. I think that's interesting from Barclays. Doesn't really seem to be making a splash among investors this morning, even though they had some less positive things to say, cutting the group. But we just saw mortgage apps that looked really good. And of course, rates look contained. So what's the problem with the home builders? Shouldn't we be loving them right now?
Yeah, I mean, obviously, if you look at home builders since September, when the Fed started cutting the short-term interest rates, long-term rates, and we've talked about it since then, have been rising. They've settled a little bit, so there may be a little bit of some bottom fishing in the home builders because rates are softening close to about 4.2% on the 10-year. But nonetheless, I think if you look at Barclays' call, it's quite interesting, actually, because it fits with what I see going on in the home space or home builder space. But they cut across the board the major players, KBH, and all these, by the way, they had an overweight rating, and now they're moving their rating down to sector weight or equivalent ratings. KBH, they moved it, from 899 to 85. If you look at Lennar, they cut that one from 210 to 181, and DR Horton, which is the larger player, from 192 to 170. But essentially, they're mentioning that they believe, now this is Barclays, the group has essentially played out in terms of the outperformance, which has been significant over the past couple of years. But in the last year, there's been some softness in this space. I think if you consider also the rate environment we're in, it's still an elevated rate environment. 10-year around between 4 and 4.5%. And of course, long-term rates for mortgages are in the high 6s, low 7s, depending on your credit rating. So still elevated rates. But one of the things I think is going on here is if you look at their note, they're still constructively bullish on the building materials names within the home building industry space. So what I think is going on is a lot of these home builders have been holding, marginally unfinished homes, maybe let's say 95% finished, unavailable for sale. So that's reducing the availability of for sale of the homes. It's keeping prices high, inventory low. But that's something that the home builders can't continue to do for quite some time going forward. So that might be why we're seeing the material stocks hold up according to Barclays' call. But, essentially there's a lot of inventory that's not available for sale because it's marginally completed. In other words, it's just fractionally off from completion.
Okay. Boy, so it sounds like there are still some supply and demand, definite inefficiencies.
Yeah.
And there's no question about that, right? But it's still generally, for the most part, like an okay problem for home builders to have. I mean, it's there's a worse problems. It doesn't seem like they way overbuilt. They're doing the opposite. So.
Yeah, that's the thing. So what's happening in the home builder space for the new construction is the suppliers have become more concentrated in terms there's fewer of them. So they're all basically maintaining resale prices higher. They're not increasing the supply available for supply or to supply quickly. So they're maintaining high prices, and that's good because of the inelasticity of demand. Now, they could make the case that there's a lot of regulations, there's a lot of regulatory, hang up and barriers to build new homes. With the Trump administration, I suppose they can't make that excuse anymore. But nonetheless, prices will remain firm. I think Barclays' call here is really about, the expectations next year versus the last couple of years, which have been really fantastic for the home builders overall as a group.
Okay. All right, ITB, though, the ETF has been a bit sluggish, did pull back alongside the rest of the market the last couple weeks. Yeah. So I would think it would catch a little bit of a bid. Maybe this note is kind of keeping a lid on it, but the ETF is up about 60 bips right now. XHB, which some also like to look at, is up about 80 bips. So home builder's not down on this. And the message may be one that is going to take some time to revisit. But I think there's also sort of a valuation case kind of built in there. So not necessarily a deeply negative thing about the economy. George, let's talk Macy's. Shares are down 11.5%.
Yeah.
This is after they said, there was a delivery expense mistake that one person made. It's a fascinating story for a stock that doesn't really have a lot of room for negative surprises.
Yeah, I mean, so if you look at the print, obviously the print in earnings represents this this expense restatement that's been material, and it's not necessarily been a business or a comprehensive aspect of the business, so it seems will be a one-time incident. But nonetheless, if you look at the EPS, they came in ahead of estimates at only 4 cents versus 3 cents, so it was already built in that they were going to essentially take this one-time charge. That was significantly lower than the 21 cents the company earned last year. So you can't really look at the comps compared to last year for this quarter. But sales were actually slightly higher at 4.74 billion versus 4.72. But irrespective of that, the sales were still down about 2.4% compared to the same quarter last year, where the company earned or sold in terms of total revenues at 4.86 billion. Now, if you break down the business units, there's some goods and bads. So I can see why the stock is down because it did guide a little bit softer for full year fiscal top line sales just fractionally. But if you look at the comp sales system wide, they were down 2.4%. And that's, of course, the majority Macy's franchise, which they have, looks like 735 stores. And those number of stores were down about 6.3%. So they're shuttering the least profitable components of that business. But if you look at Bloomingdale's, which they have 59 stores, so it's less than 10% of the total, master franchise Macy's, those same store sales were higher by 3.2%. But the other one I think is interesting here is their Blue Mercury stores, which is essentially their beauty. Yeah, that they're competing with Ulta, and I think if you look at their comp sales for that business, 3.3%. But at the same time, if you look at the number of stores that increased, so that was again the existing stores at 3.3. The total number of stores increased by more than 3%. So for what it's worth, they seem to be encroaching a bit on Ulta's business. But nonetheless, Macy's is still struggling system-wide, and that's why we're seeing the stock under pressure.
Okay. Well, look, it's in a lot of competitive places, and it's not easy to generate a lot of top-line growth when you're competing with so many different outlets. Yes. That shows up in Blue Mercury in a big way because that kind of was sort of one of their secret, hidden weapons, but when you're up against Ulta, you're up against Sephora, you're up against DLF, I mean, it's just, it's tough. George, the overall trend just looks pretty ugly for Macy's, I gotta say, especially with consumer doing so well. It just seems like a really rough trade. Like, I don't know what the point of being in Macy's is in when you can play the consumer in so many different ways. Dillard's, too, it kind of makes me wonder, why their stock has done so well.
Well, I was going to say that, if you look at Macy's, and there's a trend obviously going on, they're shuttering Macy's stores. And if you look at the EPS estimates for next year at $2.57, that's lower than 2025's estimates at $2.73, with sales actually expected to be down by $1 billion. So they're already cutting guidance for EPS and revenues going into 2026, which tells me they're shuttering stores. So it's still a value trap, right around 6 times forward earnings for 2025, 6.5 times 2026. And that's why I think if you look at Telsey Advisory, they maintain basically a market performance $17 rating because there's nothing really compelling in the stock because their flagship stores are being shuttered as they should, as they're sort of recalibrating their business.
All right. Thanks, George. Appreciate that. Macy's getting slammed here. Thanks, GT. Good look at the sell-off here. Also, as mentioned for GM, they're pulling the plug on robo-taxis. Not going to fund Cruise, so they're out of that game.